Taxes feel like a puzzle you never learned how to solve. If you want to keep more of your money, you need a map, not a riddle. Think of taxes as 3 layers you deal with every year: withholding from your paycheck, what you owe on wages and investments, and the rules that change based on where you live. First layer is payroll taxes. Your employer withholds Social Security and Medicare from every paycheck, then sends a chunk to the government before you see it. Those taxes are shared between you and your employer, partly to fund programs you use now and later. You don't decide the numbers yourself, but you do decide how much you put in by your choices at work and later in retirement. Second layer is federal income tax. The IRS uses brackets that rise as your income climbs, so the tax rate on the next dollar can be higher than the rate on the first dollar. The result is a marginal rate, not a single number you pay on everything. Your actual bill is built piece by piece as your income crosses each threshold. State and local taxes add another layer. Some states have no income tax, others tax wages, and some cities add their own charges. The total you owe depends on where you live and how much you earn. It's easy to overlook, but it matters for your bottom line. To see how it works, picture a simple example. If you earn $50,000 in taxable wages, a portion goes to payroll taxes right away, and a portion goes to federal income tax after deductions. The exact amount depends on your filing status and your deductions. Add state taxes if you live somewhere that has them, and the total tax bite starts to add up. Withholding acts like prepayment. If you fill out your W-4 with numbers that don't match your real situation, you end up with a big refund or a bill when you file. The good news is, you can adjust this any year to keep your money working for you. You're not stuck with the first setup you chose when you started a job. The W-4 form determines how much is taken from each paycheck. It's not a one-time setup. You should revisit it if you get a new job, if your spouse starts or stops working, or if your income changes a lot. A small adjustment can move hundreds of dollars each month from waiting in a tax refund to working for you now. Tax brackets apply to your taxable income, which is adjusted by deductions. The first slices of income are taxed at the lower rates and the higher slices at higher rates. You don't pay the top rate on all your income, only on the portion that falls into each bracket. That is why a few dollars here and there in income can change your total bill more than you expect. Standard deduction versus itemizing. The government gives you a standard deduction to lower your taxable income by a fixed amount. If your eligible expenses are higher, you can itemize and subtract those instead. It sounds technical, but it simply means you choose the easier path or the path that saves you more money. Most beginners use the standard deduction because it's simple. Itemizing only helps if you have big mortgage interest, high state and local taxes, large charitable gifts, or medical costs that exceed the threshold. If you're not sure, run the numbers both ways or ask a simple question to a tax pro. Credits change your tax bill directly. Deductions reduce your income, but credits reduce the tax you owe, sometimes turning a liability into zero. They are powerful, but you have to know they exist and whether you're eligible. This is where your effort to learn pays off. Examples include the child tax credit, the earned income tax credit, and education credits. These credits can be worth a lot relative to your income and can refund even if you don't owe much tax. They're designed to help families and lower-income workers, but many people miss them simply because they aren't looking for them. Tax-advantaged accounts can dramatically cut taxes now or later. A 401k or traditional IRA reduces your current taxable income, while a Roth IRA offers tax-free growth for retirement. The choice depends on your current tax rate and your expectations for the future. You don't have to decide all at once. You can adjust as your situation changes. Health savings accounts can stretch a lot more for health costs. If you have a high-deductible health plan, an HSA lets you contribute pre-tax dollars, grow tax-free, and spend tax-free on qualified medical expenses. It's a triple tax advantage, but you need the right plan to take full advantage of it. Investing brings its own tax rules. Long-term capital gains are taxed at favorable rates, usually lower than ordinary income, while short-term gains are taxed as ordinary income. Being mindful of when you sell can save you a surprising amount. You don't have to be a tax guru to make better selling decisions. Planning isn't about evasion, it's about timing and choices. You can harvest losses to offset gains, you can hold investments longer for lower tax rates, and you can use tax-efficient funds. Small changes, repeated over years, compound into real money. Freelancers and side hustles add another layer. You may need to pay quarterly estimated taxes to stay safe from penalties. The goal is to avoid a big bill in April by paying across the year. If you ignore this, You might end up with penalties and interest that sting more than the work ever did. Safe harbors help you avoid penalties. If you pay enough during the year, you won't owe extra at filing. The exact rules depend on your situation. It's not glamorous, but it's practical and saves you stress in April. Now, the actionable plan in 4 steps. Step 1. Create a simple tax plan and calendar. Step 2. Max out retirement accounts, starting with any employer match. Step 3. Track deductions and credits with a lightweight system. Step 4. Do a yearly tax check-in and adjust. Step 1 is a calendar you actually use. The calendar should include W-4 reviews, quarterly estimated tax reminders if needed, and the IRS deadline in April. Put a note on your phone or in a planner so you don't miss updates. You'll save yourself a lot of headaches if you stay ahead. Step 2 is about using the best lever you have, the accounts that cut taxes now or later. If your employer offers a 401k match, contribute enough to get it. Then consider a traditional or Roth IRA based on your tax picture and future plans. This is how you build wealth without paying more than you need to. Step 3 is to track deductions and credits without turning your life into a paperwork nightmare. You don't need to itemize every year, but keep receipts for charitable gifts, medical costs, education expenses, and any business costs if you're self-employed. A simple folder or a basic app does the job. Step 4 is about planning investments for taxes. Favor long-term holdings, be careful with rapid trading, and consider tax-efficient funds and accounts that suit your situation. The goal is to keep more of what you earn while staying in good standing with the IRS. A simple, real-world example could help you see the effect. Suppose you're 30, work a steady job, contribute to a 401k up to the match, and also put money in a Roth IRA. You lower your current tax bill while building tax-free growth for later. You're not buying perfection, you're buying consistency. If you have a small investment account, you can think about tax loss harvesting. It means selling investments that are down to offset gains, but you have to be careful about wash sale rules. It's not a magic trick, but it can reduce taxes if used thoughtfully and in the right context. This approach won't guarantee huge refunds, but it creates discipline. It makes you think about what you owe and how your choices today affect tomorrow. You'll feel more in control when you know where your money is going and why. What should you do this year to start? Revisit your W-4, ensure you're not overpaying or underpaying, and check that you're contributing to tax-advantaged accounts. Small adjustments now can save you money later and reduce the stress around tax season. Get your documents organized now. Gather W-2s, 1099s, receipts, and statements, and put them in a folder or a simple digital system. That saves you time when tax season arrives and makes it easier for you to see what you can optimize. Common mistakes to avoid include ignoring withholding issues, missing credits, misreporting income, or thinking tax planning is only for big earners. Even small steps can compound into real savings. Don't assume that the IRS has seen your entire life story. Keep it simple, accurate, and proactive. Where to learn more? The IRS website is the official source, and reputable personal finance sites can explain specifics in plain language. If you want hands-on help, a qualified tax advisor can tailor a plan to you. They can help you understand your unique situation and avoid common pitfalls. Remember, taxes aren't just a burden. They're money you can direct toward the things that matter, like a home, a future you can control, and the freedom to invest in your dreams. The more you learn, the more you'll see how much of your money you can keep and where to put it to work for you. If you're just getting started, the goal is simple. Understand the basics, set up a plan, and take one small step this week toward better money habits. The path isn't glamorous, but it's steadily moving you toward more financial control and less stress. The more you learn, the more you'll see how much of your money you can keep and where to put it to work for you. It's not magic, it's steady habits over time. So start with the basics, then build a routine that fits your life. Taxes aren't glamorous, but they're a tool you can use to build real wealth. If you found this helpful, like this video, subscribe for more plain language money talks, and drop a comment with any questions or topics you want covered.